Now, for the purposes of this video, we're going to talk about investing and trading within the stock market specifically. We won't be talking about real estate, cryptocurrency, gold, fixed income, or private investments, just the stock market. Now, the good news is both investing and trading work well, like really, really well. So I'm going to cover first investing because it takes a lot less time to explain and execute on, and then I'm going to go ahead and cover trading. Now, for those of you who do not know who I am, my name is Stephen Brooks. I'm a hedge fund manager who has done really well using systematic option strategies, mostly in the S&P 500 index. Now, when it comes to investing, you need to think long term. The reason is, and this is what nobody will tell you, is that the compounding effect that everyone talks about on Reddit and Instagram, compounding is the eighth wonder of the world or whatever they say, it doesn't really kick in until many decades down the road unless your starting principal is really high. In fact, compounding doesn't really make a huge difference until the final 2 or 3 years. Now, Fidelity did a study where they looked at their best performing accounts and they found 3 things that all of those best performing accounts had in common. Number 1, the account owners were dead. Number 2, those accounts had contributions, deposits into them at least once a month. And number 3, the dividends were automatically reinvested. Now, what does this tell us? Well, number 1, if you're looking to invest, buy and never sell. Contribute once or twice a month and reinvest all the dividends, because dividends are actually responsible for 40% of the historical returns in the S&P 500. So all you have to do is find a low-cost index fund, set up automatic monthly deposits, turn on automatic dividend reinvestments, and you're done. You do not need to do anything else than that if you are interested in investing. Now, inflation runs at about 4 to 5% per year. GDP is like 2 to 3% per year. That gives you your 6 to 8% annualized returns. And that's pretty much what the stock market has delivered historically. Now, odds are something like that is going to continue unless AI, completely wipes us out as a human race. Now, if you're like me, if you'd rather not wait 20, 30, or 40 years for the money that you've worked so hard to earn to start impacting your life today, well, then there is trading. Now, trading is not what you think it is. It's not sitting in front of multiple screens all day, wearing a headset, watching CNBC. It is not any of that. And it is definitely not like putting 10 indicators on a chart and expecting magic to happen either. It's none of that. Trading is simply risking our capital when we have a positive expectancy, when we expect to get compensated for the risk we are taking. When we expect to risk $1 and get something like $1.05 back. Now, here's a concrete example. Ooh, there you go. Here's a concrete example. The circuit breakers that protect the market from catastrophic losses, they're turned off after 3:25 each day. So if we sell certain types of options in the final 35 minutes of the trading day, we are taking on extra risk that does not exist during the rest of the session. There are strategies where the expected value of doing this is positive because we are being compensated for taking on that risk. Now, trading is about finding embedded edges in the market. When we take risk in those specific periods or moments, we have a positive expected value. And our goal is to essentially spam bet, to repeatedly risk our capital during those embedded edge windows. Think of it like a casino, right? A casino's goal is to get you to bet more because they have a positive expected value every single time you bet. More occurrences for them means more profits. Same principle. If you put $1 out and we expect to get $1.05 back, we want to press that edge as many times as possible. Now, on a normal day, I'm doing somewhere between 20 and 50 trades. And that number varies because embedded edges are more available on certain days than others. And I'm not doing any of this manually. A bot handles all this for me. Now, both approaches work. Investing is simpler. And because it's simpler, the outcome is, in my opinion, not as favorable. Yes, trading feels daunting and you need real capital to execute 20 to 50 trades in a given day, no doubt about that. But this is 2026, and all of it can be automated. Trading, done right, can produce returns that investing simply cannot. We're talking multiples of what the market returns actually are. Now, we have two options for you depending on where you are at. First, if you are an accredited investor and want to invest in our fund, there will be a link below this video. We run systematic option strategies mostly in the S&P 500, 20 to 50 automated trades per day, each taking advantage of different embedded edges in the market. We operate entirely intraday, so there's no overnight exposure. Second, if you want to learn how to find some of these edges yourself and use our software to place a high number of trades for you, especially if you're someone who wants more cash flow right now, there will also be a link below this video if that's what you're interested in.